the gap between real GDP growth on a year-over-year basis and real GDI growth on a year-over-year basis has never been this wide. It was 2.5% in the first quarter, and we thought, okay, this will close. This is going to, we're going to find out, how weak is weak when the second quarter is reported. Well, second quarter GDP was in real terms was up 2.5% on a year-over-year basis, and the GDI year-over-year growth rate in real terms was down 0.5%.
The upcoming Federal Open Market Committee decision is scheduled for September 20th. This announcement will also provide an updated summary of economic projections. According to the CME FedWatch tool, the markets are currently indicating a 93% probability that there will be no change to the Fed funds rate at this meeting. In contrast to the United States, Europe is grappling with a more persistent inflation challenge. Investors and analysts are increasingly concerned about the potential for a divergence in economic outcomes and policy responses between the two sides of the Atlantic. While consumer price inflation in the US surged to multi-decade highs last year, it has since declined significantly, and is now at a much lower level. On the other hand, annual wage growth for workers in the UK and many Eurozone countries has outpaced that of their American counterparts in recent months. Cathie will now delve into a detailed discussion of economic indicators, market settlements, and various signals within the market.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The non-farm payroll employment was a little better than expected at face value or at first glance, 187,000. But when you include the revisions, down 110,000 in the last 2 months, that netted out at 77,000. That's quite weak, actually. Now, the household survey, again, something for everyone in this report, was up 222,000, but the unemployment rate really shot up from 3.5 to 3.8, still low, but a big increase over 1 month's period. And so that was somewhat surprising. The participation rate continued to move up, 62.8%. And many commentators thought that was a bullish signal. And it is, more and more people participating. But if we're right, this also could be a signal that the consumer is tapped out and needs to either get a second job, or another person in the household needs to get a job. So that could be partly what's going on right now, and we suspect that is. Average hourly earnings were up only 0.2%, so that's 2.5% at an annual rate, though still up 4.3% year over year. If productivity is increasing as we think it is, that means that on a year-over-year basis, the unit labor costs, or real wage gains in this case, could be below 2%. And at an annual rate basis could be close to zero. So very low inflationary ramifications. I know that a lot of people are focusing on some of the negotiations taking place and some of the wild and crazy settlements taking place, and I'll get into that in a moment. But we think that's going to backfire on those companies. Hours worked, the average work week was up 0.1 hours. And so that kind of takes the edge off of a very weak employment growth number. Temporary help continues to go down, though. Those jobs are going down. And so it's all coming into place. It's taken longer, certainly, than a lot of us expected, but it is all working out, I think, the way we have expected. Speaking of earnings reports, it is shocking to see, first of all, on a year-over-year basis, earnings are down, but the top-line growth of many companies is well below the 6 to 7% nominal GDP number. In fact, we're seeing negative top-line numbers out of a lot of the retailers. on a year-over-year basis, their sales are down. So again, probably an indication of how the consumer is feeling. What is helping to make sense about all these contradictions is an identity I mentioned in the last in the know, and that is GDP growth versus GDI growth. GDP is gross domestic product, so consumption, investment, government spending, and trade, or net exports, and then inventory changes. On the other side of that, the identity, gross domestic income, is simply the various income reports out there, wages, profits, and so forth. And those statistics are more reliable in the short term, whereas gross domestic product gets revised, sometimes quite dramatically around turning points in the cycle. Gross domestic income does not, or is revised much less so.
While Europe's growth is notably weakening, the United States has recorded a 2.1% annualized expansion in the second quarter. Additionally, signs of labor market weakness have sparked optimism about a soft landing in the U.S. economy, potentially curbing inflation without triggering a recession. In contrast to Europe, where both corporate and personal incomes have faced greater challenges, the U.S. has seen a more robust resistance to losses. This has resulted in deeper embedded inflation in Europe. U.S. policymakers and economists are generally more optimistic about the trajectory of inflation. Most anticipate that price pressures will continue to ease, at least in the coming months, as demand moderates, supply chain bottlenecks unwind, and the labor market cools. Now, let's return to the video as Cathie would delves into various market signals.
The best sector has been energy. Energy prices have gone up. We got some data from Saudi Arabia today, or on Saudi Arabia and Kuwait. Their exports have collapsed. They've gone from, in the case of Saudi Arabia alone, I think roughly a 7.5 to 8 million unit barrel range down to 5.5 million. I mean, that's unbelievable, especially because at these prices, even at these prices, it was break even at the prior level of production. So it's probably in a deficit position, and we're marveling at the prices it's paying to attract sports franchises. So, that's a big disconnect out there. Nonetheless, energy sector was the best. And, if Saudi Arabia is going to normalize its production schedules, which it will have to pay for all these sports franchises, we believe that energy prices will come down, especially as electric and autonomous make their way into the system. Healthcare and communication services were the next best. And while energy was up, healthcare and communication services were down. On the other side of the ledger, interest rate sensitive stocks and categories were hit hardest, utilities and real estate, because the 10-year Treasury yield, because interest rates went up. The other category that was down, and this is surprising when the market is in a weak spot, consumer staples tend to outperform. They did not this time. And I think it is because of what I've mentioned about their pricing power, at least the power they thought they had, really diminishing quite significantly. In the beginning, the market is beginning to understand that. Fixed income, as I mentioned, interest rates went up, hurt those interest rates sectors, but it was a really important test. We really didn't make it past the peaks from October of 2022. Now, what is the similarity between now and then? Back then, the Chinese yuan was depreciating at a rate that the Chinese government did not like. And so it started selling our bonds, and its reserves have actually been going down. Its dollar reserves are down from a peak of 1.2 trillion to 834 billion now. And the reserves are dropping 10 to 20 billion a month. we believe that this last month, which is when the yuan went back to the level where it was last October, that the PBOC was selling its dollar reserves aggressively in order to get dollars to support the yuan. And so we wouldn't be surprised to see a very big drop.
Former Bank of Japan board member Gashi Kataka believes that the Bank of Japan can start moving away from its accommodative monetary policy once it ensures the sustainable achievement of its 2% inflation goal. Kataka anticipates that the spring 2024 wage negotiations will be pivotal in the Bank of Japan's inflation mission. He emphasized the need for nominal wage increases next year at least as significant as those of the current year to establish a virtuous cycle of income, spending, and prices. Kataka also outlined a step-by-step plan for the Bank of Japan's policy exit, starting with removing the peg on the 10-year Japanese government bond yield. Regarding the Bank of Japan's July action aimed at making its yield curve control more sustainable, Kataka criticized it as an unwise move, noting that there were no significant market distortions. He suggested that allowing the guide rate to effectively go as low as 1% would only be possible once the 2% inflation target is achieved. Kataka also commented on Japan's gradual economic recovery, highlighting slow progress in production and domestic consumption, and the government's limited efforts to boost public disposable income. Shifting focus to the Eurozone, Kataka mentioned that the headline inflation rate remained at 5.3% in August, driven by rising fuel prices and the removal of energy subsidies in some countries. Core inflation, excluding energy and food, experienced a slight decline within the Eurozone's single currency bloc but remained close to its early year level and near a record high set in March. The video invites viewers to share their thoughts on Cathie Wood's macroeconomic outlook in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.